that's big money. And they're tightening
Why?
liquidity.
Why are they doing that if their economy is already in recession? If you look at manufacturing PMIs, and then also how does the Bank of Japan? Yeah,
to try and stop the yuan devaluing through 7. And as I said, someone's shaking the tree. So you've got one big problem there. Now, let me get back to answer your question. Why is the Fed 3 to 4 times more important? It's because of Basel III regulations, factors like that, which have constrained banks in terms of their ability to lend, the importance of basically going to the Fed, getting access to the repo, the standing repo facility. It's things like the tax control of the euro-dollar markets back about 5 years ago under Trump, where money was repatriated back to the US. It's also the FX swap market. I mean, these are factors which are absolutely critical. And the Federal Reserve is basically, turning the dial here.
Do you agree, Joseph? Is the Federal Reserve to have the reins?
No, absolutely. I think that, so they definitely have a lot more power. So if you think back to earlier in our discussion, Fed in the beginning was a lender to last resort for banks. And that lender of last resort role has been expanding to basically almost everyone now. So if you think back during the GFC, it expanded its role to lender of last resort to the Eurodollar system through its FX swaps, as Mike noted. And it also expanded as a lender of last resort to the dealers and the money market funds. And to basically the shadow banking sector back. Now, if you think back what happened in March 2020, they further extended their lender of last resort role to include corporations, right? There was a corporate credit facility. And also the Fed tried to become lender of last resort to businesses and individuals through their PPP loan facility, which is basically working with the government, asking banks to make loans to small businesses and people, and the Fed would provide liquidity for that. Now, the Fed doesn't actually have the infrastructure to directly give money to people individually, so they have to work through the banking system. And that's the one aspect in their lender of last resort roles. But there's another aspect that they've become a lot more influential as well, and that's through the regulatory aspect. And as Michael noted, Basel III greatly expanded the regulatory powers of the central banks. And now we seem to be moving towards a world where the Fed maybe be able to, suggest to banks that they have to do certain kinds of lending. For example, perhaps they want a bank to make green loans to support green infrastructure, right? So they seem to be pushing towards that model. And to be clear, that's a model it's not uncommon. If you think back, let's say 30 years ago in Japan and much of Southeast Asia, the central banks operated like that. They would basically direct their domestic banks to lend to certain key industries. So it seems like we're moving towards that kind of industry as well. So the Fed is basically becoming much, much more important, both in the financial and the real economy. And I'm not even sure that's a good thing because, as we all know, central bankers, they don't stand for elections. And if you work there, you can never be fired. So you don't really know if they're making good decisions. And if they aren't, there's nothing you can do about it.
Joseph, what about the Federal? So they've reined in the Eurodollar system, according to you both. They have essentially complete control over the reserves, which they can control with the wave of their magic QT wands. What about the commercial banking system, which is extremely important for inflation? After in the wake of the great financial crisis, commercial bank lending to real people like the three of us, to businesses, was muted, even though quantitative easing cannot force banks to lend, even though it can force an explosion of reserves, which can lead to an explosion of deposits. But those deposits are not loans; they are deposits from banks buying treasuries, mortgage-backed securities from their own customers. So, in what way, if before this whole inflationary disaster happened, the Fed couldn't stimulate bank lending? Can the Fed not be able to moderate bank lending? And what if we have a out of control, banks are lending way too much money in 2022, 2023, and the Federal Reserve does not have control of that? Joseph.
Well, that's the next phase of this. It's the CBDC. It's a new toolkit for the Fed to be so that they can do things like this. Now, this idea, it's actually out in the open. So if you recall, last year, Saul Omarova, which is a professor in law, was nominated to be one of the top bank regulators in the U.S. And she has a paper and she talks about how she thinks the economy could operate. That is, in her view, basically, the Fed makes loans. And, the Fed kind of determines who gets money and who doesn't. It's a basically further expansion of the Fed's power. Now, we're not there yet. We're still building the technology, but to me, the trajectory, if you look past the past 20 years, across financial markets, across regulation, this is, I think, what many in the Fed and a certain faction in the politics want the Fed to move towards, and it's already happening in other countries. If you notice, CBDCs are most popular in countries that have basically authoritarian in structure, like China. So it seems that we might eventually drift towards a world where the Fed could solve the problems you mentioned, Jack. We just have call up Jay Powell and he'll give his friends money. So
Yeah,
gotta make sure you have to be friends with the politicians.
well, that's why I'm friends with you, Joseph. So that's a long-term view. But what about 2022, 2023? CBDCs, the Fed coin, is not likely coming within the next 2 years. So I'm just going to put up a chart from your excellent report on FedGuide.com, which shows bank credit creation. And you write that unless credit creation in 2022 rivals the historic growth seen last year, bank deposits look set for the first annual decline since the early 90s, which sounds deflationary. But that decline in bank deposits is due to quantitative tightening and the reverse repo facility, not credit creation. And as we know, credit creation is the sort of the big player when it comes to inflationary money creation, because it's creating, it's alchemy. It's creating money from nothing. So what if this blue line continues to spike higher and the Federal Reserve, it doesn't have an ability to stop bank lending, right? I mean, what happens if inflation goes to 10, 11, 12% because of this?
I think that's an interesting question. Bank credit creation is really strong. So at least some segments in the economy, they're doing okay, at least well enough to continue to borrow. And we're in an inflationary environment. Everything costs more, and everything costs more. You're going to need to borrow more money to buy the same things that you used to buy. So it's going to be it's definitely something to watch, because we do seem to be going into a slowing economy, maybe a recession later on. If that happens, and you'd expect credit creation to slow down as well. So far, don't see that, but storm clouds seem to be gathering.
Yeah, I mean, it could be the case that you get an acceleration in loans in the near term if there is a recession, because corporations will just draw down, predetermined, loan credit lines when they need them, and I think that's feasible. The issue I would bring up is how do banks fund their balance sheets and that lending in an environment where deposits are shrinking and the money markets are tightening hugely. I mean, these are problems the banks have got to face. And therefore, we've got a bigger problem out there to face. A Fed accident.
That's a great transition to the one topic where you gentlemen have slightly different views, which is on the value and future prospect of duration, long-term treasuries. Michael, I think you have the view that treasuries are close to being a buy here because of the slowing economy, whereas Joseph, you think that quantitative tightening as well as the prospect of sustained inflation make treasuries not a buy yet. So, Michael, how about you share your view first, and then we get your view, Joseph?
I think that what I would say is that there are a number of moving parts one's got to look at. I mean, one is, what is the underlying level of inflation that the system will essentially converge to? My view is that it likely is not a lot different from what we saw pre-COVID. So I would say that maybe in the US we're talking about somewhere between 2 and 3% probably underlying inflation. My view is that that's largely demographically driven. Basically an aging society, as all the West is basically low inflation. I just don't buy the other argument which many people cite. I think it's deflationary, and Japan showed that. But I think it takes some time to get there, to get back to that level because of the persistence of inflation. Now, my view is that the bond market will price that. They'll look through any near-term surge, and you will not get such a hike or a necessary hike at the front end. Consequently, I would say that maybe 3% is probably the level that Fed funds can go to. I'll come quietly and maybe accept a little bit more, a tad more, but at that sort of level. Now, if you look at the opportunities for the back end for 10-year treasuries, that's really driven by term premia, and term premia are a factor that are already very negative, but I think they could go a lot more negative. And one of the things that both fixed income and equity investors have got to think about is that equities never rally until there's been a subsequent or previous surge in the fixed income markets. Fixed incomes, 10-year bonds have got to move price-wise up significantly before equities begin to turn. And in other words, what you're going to see is a drop in long yields at some stage. Now, I think that's a recession-driven event.
So I'll just give my side, and that's what makes a market. So I could be wrong. So I think of ultimately the fundamental for any asset prices is just supply and demand. And if you look at the supply side of treasuries coming online in the next few years and the demand side, it's actually very stark. So if you count for QT, the supply in treasuries the next few years is going to be 1.5 trillion each, and that's a lot for the market to handle, especially as we've noted, market liquidity is not very good. And so when you don't have very good liquidity, you can have large price moves with just small volumes. On the buying side, you'll note that over the past few years, we've had different sets of marginal buyers. So pre-COVID, it was the hedge funds, and they bought, let's say, a lot. So compared to then, they've kind of taken down their exposure by almost $1 trillion. So they were buying a lot of treasuries, part of their cash futures basis trades. Post 2020, it was the Fed and the commercial banks. Fed doing QE, commercial banks, putting their QE cash to work, and now all of that is going away. So you're going to have a new buyer. I don't know who it is yet. The foreigners aren't going to step in because when the foreigners buy, they have to FX hedge it, and when you FX hedge it, it's based on front-end rates, and front-end rates are going higher, so it's not going to be worth it for them. So we're going to have a new buyer come in, and it's not clear who that is. So there's going to be a phase of price discovery that probably be volatile and probably be much higher. Because if you know the marginal buyers in the past, the hedge funds, they're buying as part of a spreadsheet. They don't actually care about where the yields are by themselves. Fed doesn't care, and commercial banks, they're regulatory driven. And foreign banks, they're partially regulatory driven and in part because of what they have at home, it's just negative rates. So if you want to move to people who are more fundamental driven, you actually need people who need higher returns. And so that's why I think that rates will go higher, and maybe significantly so. And so I would just present the case for aging demographics being inflationary. That's originally from Charles Goodhart of the Bank of England. I used to think that aging demographics was deflationary as well, and that's kind of what I hear most of the time. But this idea of aging demographics being inflationary, I think it's super interesting. And basically what it's saying is that when you have aging demographics, you have lower supply of labor. And if you decrease the supply of labor, you're going to get higher prices because wages go higher. One way to think about this is, let's say you're retired. Okay, so tomorrow you're 60 years old, you don't work anymore, right? Okay, so you're no longer producing goods and services into the economy. However, you continue to consume. You continue to, I don't know, if you're a boomer, maybe you have a yacht somewhere and you're just kind of living the high life. So you continue to buy stuff, right? So maintaining demand of goods and services, reduce supply, that's higher prices. So people often point to Japan as the quintessential example of how aging demographics can be deflationary, and that is a puzzle. But I think one thing to note, and what people who hold this view hold, is that in a globalized world, labor is a global pool. So even though Japan itself was aging, when it was going through that phase, globally, there was still enormous supply of labor from China and from, let's say, the developing world, right? So what's changing as we go forward is that China is also aging tremendously and very quickly. In fact, they're just because of their one-child policy and so forth, they're just going to be aged much faster than everyone else. So you're going to have a world with more people who are buying, consuming, and fewer people working. So structurally, that seems inflationary to me. And not saying that everyone buys bonds based on fundamentals, because they don't. But if you do, that's something to keep in mind.
But I think, to argue against myself, I think the other two factors to think about here are what other central banks are doing. And although we dismissed the Bank of Japan or I did, and the ECB, I think they do have some role in the bond markets. And the reason for saying that is that bonds tend to correlate together much more than equity markets do. Anyway, traditionally they have done. And the fact is that if the ECB loses the battle on inflation, which it looks like it's doing rapidly, what's going to happen to the Bund? I mean, the charts on the Bund don't look great right now. And that's one of the things that could feed back into the treasury market. And the other is just, look at the devaluation of the yen. I mean, we've had a big one already, but it continues to devalue as we speak. And if it can't keep going, it won't. And at some stage, the Japanese are going to, reality is going to hit, and they're going to have to tighten policy, and that is going to be an earth-shaking move if they start to do that. So we may get pressure on the long end of the bond markets through those two shocks, and we shouldn't dismiss that. So I'd put a toe in the water at the long end of the market, but I'd be much more comfortable with the front end.
I think that's a really good point about Japan, Michael. I mean, like you mentioned, the rate of depreciation that the yen is doing, it's historic, and they can't go on forever. Sooner or later, the BOJ is going to have to do something, and what they'll do is probably relax the boundaries for yield curve control. So maybe they'll let the 10-year go to 50 basis points or something like that. That's going to be a sudden shock throughout the global bond markets, and it's going to be very disruptive because a lot of people will be surprised. For all we know, maybe he'll do a surprise announcement, and people won't be prepared for that.
Right. The idea there being that global bond investors look at a German 10-year Bund in the same way they look at a German 10-year Treasury yield. They just hedge the FX risk, or a 10-year Japanese government bond. So if the yield on the Bund goes from 0 to 3, then the 10-year Treasury should probably go from 2 to 5 or something like that. Both of you expressed a little bit of conservatism about how high the Fed funds rate, the short end, can go. My question is, if we look at let's say the financial conditions index, the Goldman Sachs financial index, which is, in some way related, I'm going to guess it's in some way correlated to your global liquidity index. It's probably a little more imprecise, and it has more motley factors. It's got, the dollar, interest rates, credit spreads, equities. How much of that of the interest rates can continue to go up? And obviously the Federal Reserve monetary conditions have to tighten more. So do equities have to go down? Does credit spreads have to widen? And can you specifically speak about why you think perhaps that the peak is going to be something like 3.5% of the Fed funds rate, and that we don't get to something like 5%, which is obviously a tail risk scenario?
Well, I mean, to answer that question directly, I think that you don't necessarily need the Goldman Sachs Financial Conditions Index. Just look at the Treasury market, and if you dissect the Treasury market, my interpretation of bonds has always been that bonds basically there are two key moving parts. One is the front end of the curve, which is really about interest rate expectations. So look at something like the 1 year 3-year spread or 1 year 5-year spread. That tells you a lot about what the market's pricing in for Fed rate hikes. But look at the back end, and that will tell you about term premia. So if you look at the 5-10 spread, okay, that's really a crude measure, but not a bad measure of what the term premia on the bond is. Now, what you've had going on in the markets is you've had a steepening at the front end, a very vicious steepening, and you've had a very vicious flattening at the back end. So it's telling you that rate expectations are going up and term premia are collapsing. And the collapse in term premia is all about changing risk appetite. And it's saying that bond investors do not want to take risk. They want the safety of the safe asset, which is the 10-year bond. Now, basically, what that's telling us from a corporate point of view is that corporations are raising money around about the 3 to 5 year area. So number one, their cost of financing has gone up hugely because of the front end rise. And secondly, that the appetite for their debt has collapsed simply because of the negative or much more negative term premia. So that configuration, which, at Salomon Brothers, we used to think that a flat yield curve with a big belly around the middle, around the mid-duration years, was the worst outlook, much worse than an inverted curve. And that's exactly pretty much what we've had now. So what you've got is a curve with a pretty fat belly, which is actually that the chart that you're showing kind of shows that, but it shows that there's a big extension around that middle area. And what you need to look at is to dissect that into the front end movement and the back end movement. What that is looking at is the black line is rate expectations. So that's the 1 year forward, 10 years out. And that's sort of, suggesting terminal Fed funds around 3.5%. And then you've got the orange line, which is term premia. And that is basically a measure of the risk appetite of investors in the fixed income markets. And what you've seen is this big collapse. Now, that pattern where you've got the black line crossing the orange line is what you might call for the credit markets the sort of death cross, because it says that within 12 months you're going to get a big problem in the credit markets. And typically, what you see is that unfolding. Credit spreads widen about 6 to 12 months after you get this particular pattern unfolding. And there's a chart, I think, a little bit later. It's simply a normalized z-score, in fact, of different credit spreads. So it's high yield, junk, so triple C minus single B, B minus triple A, quality spread, BAA minus triple A, these sort of things in an index in red. And the yellow line is simply the 10-year minus 5-year US Treasury yield inverted and advanced by 12 months. Now, what's happening is we're tracking exactly that movement. What the yield curve, the Treasury yield curve has been suggesting.